Hello everyone, welcome back to the class of macroeconomics. In today's lecture, we are going to talk about equilibrium. So the topics that we are going to address today are as follows. We are going to talk about what is equilibrium, how to determine the goods market equilibrium, and how to determine the labor market equilibrium. So the outline for today is as follows. We are going to talk about the goods market equilibrium, which includes the supply, demand, and equilibrium for the goods market. We will also talk about the labor market equilibrium. So again, we want to include the supply and demand and the equilibrium of the labor market. Now let's begin to look at the goods market equilibrium. So for the goods market equilibrium, the first thing we want to look at is what is equilibrium. In economics, whenever we talk about equilibrium, we are talking about that the supply equals the demand. And then what is the goods that we are referring to? We are referring to the capital goods. Therefore, when we talk about the goods market equilibrium, we need to look at the savings and investment. So now let's look at the detail for that. We say the goods market is about the goods market's demand and the supply. The demand for the goods market is provided by the investors, and the supply of the goods market is provided by the savers. And then for each period, we are interested in that the desired level of the saving equal to the desired level of the investment. So then we say that in a simple version of the model, we assume that firms need capital while the households save and supply capital. So then in graph, that when we want to illustrate the goods market equilibrium in a two-dimensional diagram, we provide a graph called the saving and investment diagram. In this diagram, we have the vertical axis that is representing the price of the goods market. Given that the price for the capital goods is the real interest rate, therefore the vertical axis is related to the real interest rate. How about the quantity of the goods market? It will be the savings desired and the investment desired. Therefore, that is how we label the horizontal axis. Now let's first look at the demand side of the goods market, which is related to the investment decisions. So what we do now is review what we learned related to the goods market demand. So the first question we want to ask is who demands the capital goods? It turned out to be the firms that demands the capital goods. Then we ask what decision are they make related to the demand for the goods market? We say they make the investment decisions. Then we ask how to make the decisions? Well, it is the firm maximize the profit by choosing the optimal level of the capital stock. And then we say earlier into this semester's class, we said that the decision rule set the marginal product of capital equal the user cost of the capital. And then so it turned out that the marginal product of the capital can equal the real interest rate plus the depreciation rate, or we look at the tax adjusted user cost of the capital, which is the marginal product of the capital equal the real interest rate plus the depreciation rate, the whole term divided by 1 minus tau. The tau is the tax rate. So then based on these two examples, we come up with the graph for how to determine the optimal level of the capital stock. We said that the firms will choose the optimal level of the K such that the marginal product of the capital equal the user cost. We know that the marginal product of the capital declines as the capital stock increases, and the user cost remain the same no matter how much capital you put into the production process, because the firms are so small to affect the price. So then on the left hand side of the graph, we have the user cost that equal the real interest rate plus the depreciation rate. On the right hand side of the graph, we have the user cost equal the real interest rate plus the depreciation rate divided by 1 minus tau. So then to determine the optimal level of the K, we just find the crossing of the marginal product of the capital and the user cost. And then we are going to determine the optimal level of the K. Once we determine the optimal level of the K, then we know how much we want to invest. We know that based on the law of motion, the KT plus 1 equal 1 minus delta KT plus the IT, which tell us the capital stock next period will equal the 1 minus delta multiplied by the capital stock this period plus the investment of this period. And then from this equation, we can convert the decision for K into the decision for investment. So then, based on the diagram, we know the investment decision will be affected by the real interest rate. It will also be affected by the marginal product of the capital. Therefore, the investment will increase if the real interest rate falls. That is because if the real interest rate falls, it will shift down the user cost of the capital so that the economy will desire more optimal level of the K, thus the investment need to increase. On the other hand, if the marginal product of the capital increase due to the increase of the productivity of the labor input, then it will shift the marginal product of the capital curve to the right. And then again, the economy will desire a higher level of the optimal K, thus the investment need to increase. Therefore, in the saving and investment diagram, as we showed earlier, how to draw the investment curve. It turned out that when the real interest rate falls and the investment need to increase, so then there exists a negative relationship between the investment and real interest rate. So then we draw this graph, and then it is a curve sloping downward, illustrate the negative relationship between investment and R. Now let's move on to review the supply side of the goods market. So then again, we want to ask that who supplies the capital goods in the goods market. It turned out to be the household. And then we ask, what is the decision that the household make such that it will be related to the supply of the capital goods? It turned out to be the saving decision of the household. And then we ask, then how they make the decisions? Well, when the households are making the decisions, they are maximizing the utility by choosing the C. Given that the household have the income, and then they decide how much they want to consume, and then what is left will be the savings. Therefore, we argue that the household decision related to the supply of the capital goods will be the decision of the consumption and savings. And that is something we already learned. So then we know saving equals the income minus the consumption. And then based on the Fisher model we know that the saving will be affected by the real interest rate, the current income, the future income, and the initial wealth. And then so we say when the real interest rate got increased, and when the current income got increased, the future income got falls, or the initial wealth got falls, all of them will lead to a higher saving. You say, hey, wait a minute, when we are looking at the changes of the R and see how that affects the saving decision, we say that it will affect the lender and the borrower differently. In here, we are looking at the aggregated perspective. Therefore, we adopt the general belief that when the real interest rate got higher, the saving will be higher. Therefore, we argue that the saving will be a function of the R, the income of current and future and initial wealth. So then, in the saving and investment diagram, we can draw the relationship between R and the savings. And in here, we know that there exists a positive relationship between savings and the real interest rate. Therefore, the saving curve in the saving investment diagram need to be a curve that is sloping upward, which indicates the positive relationship between the price and quantity of the capital goods market. Now let's put everything together, which illustrates the equilibrium of the goods market in the diagram. So we say that for the equilibrium, it is related to the equating of the supply and demand of the goods market. And the supply of the goods market is the savings, and the demand of the goods market goods is the investment. investment. So then when we plot both decisions on the saving and investment diagram, we have the saving curve that is sloping upward, and we have the investment curve which is sloping downward. And the crossing point of the saving and investment curve will determine the price and the quantity equating the saving and investment. And then the R will be the level of the real interest rate, setting the saving equal the investment. Up to this point, we have been talking about the equilibrium of the goods market under the assumption there is no government. But then what if there is a government in the economy that operates? So let's take a look at the case that when we adding government and see how will that affect the outcome of the goods market equilibrium. When we adding the government into the economy, then we want to ask then who is the savers and who is the investors. It turned out that when we adding the government will be another agents that save. And then so the agents that they save will then becomes the household and the government. So the government decision will affect the saving decisions. In here, we do not assume that the government invests. So then we take a look at the national income account identity. In here, we know that the total income will equal the consumption, investment, plus the government expenditure. In here, we assume that the net exports equals 0 because it is a closed economy. So then the national income will be consumption plus investment plus government expenditure, and there is no net export in here. Then when we rearrange the equation, what we are going to get is that the total national income minus the consumption desired minus the government expenditure will equal the investment desired. So then if we look at the equation on the left hand side of the equation, then we know that the left hand side now becomes the national savings. So then we know when we adding the government expenditure will affect the national saving. When it is higher, the national saving should fall. When it is lower, the national saving should rise. So then let's take a look at the first scenario, that is when the government operates in this economy and the government expenditure increases. How will that affect the goods market equilibrium? It turned out that when the government expenditure increases, it will causes the national saving to fall. Then it will causes the real interest rate to increase, and then causes the investment desire to fall. So then why, when the interest got increased, the investment desire should fall? Let's recall what we learned for the diagram for how to come up with the optimal level of the capital stock. In here, we have the vertical axis that represents the marginal product of capital and the user cost, and the horizontal axis is the level of the capital stock. As we discussed earlier, to find the optimal level of the K, that's the marginal product of the capital equal the user cost of the capital. Then when the real interest rate got higher, it will raise the real interest rate and raises the user cost of the capital. So then the desired level of the capital stock should fall. Then holding all the other things being equal, it implies that the investment desire also need to fall. So then in here, we have the relationship between the user cost and the fall of the investments. So then how could the whole process happen? Let's take a look at the saving and investment diagram we learned earlier today and see if we adding the government expenditure, how well the equilibrium got changed. Why we argued that when the government expenditure increase, it will causes the saving desire to fall, real interest rate to rise, and the desired level of the investment falls. How could that happen in the saving investment diagram? It turned out that when the government spending got higher, then it implies that the national saving is full, because at this point when we say when the government expenditure got increased, it means that all the other things are holding equal. So then, given that the expenditure increase causes a saving to fall, it means that at every level of the R, the saving should be less, so it shifts the saving curve to the left. When the saving curve shifts to the left, what we are going to get is that the equilibrium point will shift from the original level to the new level. In here, the economy will end up to have a R that is higher. So then you will ask, wait a minute, we say that the investment desire should decrease, but how couldn't the investment curve got shift? That is because the reason why the investment changed is because the saving got false. When the saving got false, it will causes the equilibrium price to change. When the equilibrium price got changed, then the investment need to respond to the changes in the R and then move along the investment curve. Therefore, under this case, even though the investment desire got less, but it doesn't mean that the investment curve need to shift to the left. Instead, it is the point that is moving along the curve indicating the fall of the investment desired. So we have a name for this scenario. We say that it is the crowding out effect. When the government expenditure got increased or when the government increased the purchases, it causes the investment to fall. And to sum up, we say the government expenditure increase, then the saving curve shifts to the left. When the saving curve shifts to the left, it causes the rise of the real interest rate. That is because the supply of the capital goods now become less, and so the market will respond to such a change and increase the price, and that is the real interest rate under the capital goods market. And then such a change will causes the user cost of capital to increase, and then causes the desired level of the capital stock to fall, and then it will causes the investment to decrease. And that is so-called the crowding out effect. So this scenario is related to how the government spending affects the goods market equilibrium. Now we want to look at the second scenario, which is about how the government collect tax affects the goods market equilibrium. When we talk about tax, we have to think about the Ricardian equivalence we learned before. We know that when the Ricardian equivalence is sold, when the government reduces the tax, then the private consumption behavior will not be affected. However, because the government cut the tax, therefore the after-tax incomes becomes higher. Then the private saving should increase. The increase will be exactly the same amount as the tax cut. Therefore, from here we know that the private saving increase need to be equal the government saving decrease. Then, because the national saving equals the private saving plus the government saving, therefore we know when the government cut the tax, under the assumption that the Ricardian equivalence hold, the national saving desire will remain the same. How about if the Ricardian equivalence doesn't hold? It turned out that the household faces a higher after-tax income, and then the household will choose to consume more. So compare with the earlier case, that is when the Ricardian equivalence hold, we say that when the household faces a higher after-tax income, they chooses the consumption rate to be the same, then the private saving should increase. But then under the case that if the Ricardian equivalence doesn't hold, the household will notice their higher income, and then they are going to choose to have a higher consumption. But then it will causes the saving to increase less than the previous case, because in the previous case, the saving increase due to the tax cut will be fully reflected in the tax cut. However, under this case, that is when the Ricardian equivalence doesn't hold, because now the household choose to consume more, so then the increase of the private saving will be less than the case that for the Ricardian equivalence hold. So then in here, we know that if the Ricardian equivalence doesn't hold, the household's private saving will increase a little bit, and the increase is less than the decrease of the government saving. Therefore, when the Ricardian equivalence doesn't hold, the desired national saving should decrease. Then so in sum, when there is a tax decrease, then if the Ricardian equivalence holds, then the saving desired should remain the same. But if the Ricardian equivalence doesn't hold, then it implies that the saving should decrease. So to sum up with our discussion in here, let's look at the saving investment diagram again. We have the vertical axis represents the price of the capital goods market, that is the real interest rate. And we also have the horizontal axis represents the quantity of the capital goods market, which is the saving desired and the investment desired. The supply of the goods market is the savings. The demand decision of the goods market is related to the investment decisions. And then the supply and demand curve, which is represented by the saving and investment curve, will cross at the point where the price will be the clearing price of the capital goods market, which is the R star, and the quantity will be the saving desired equal the investment desired. In here, we show that the saving is a function of the real interest rate, the current income, future income, and the initial wealth. When we add in the government, then we are going to have the government expenditure affecting the saving decisions, and we will also have the tax that affects the saving decisions. But for sure, if the Ricardian equivalence holds, then the national saving will remain the same. But if the Ricardian equivalence doesn't hold, then the tax will affect the saving decisions. So then in here, I write up the saving curve, that is the function of the R, the current income, future income, initial wealth, government expenditure, and taxes. If you may notice, I put a semicolon after the R. That is because the R, the real interest rate, is the price of the goods market. So then when the price got changed, then it means that the saving decision will be changed due to the change in the price. When the price is higher, people will tend to save more. When the price is less, people want to save less. But then if there is a changes in the current income, future income, initial wealth, government expenditure, and taxes, then it will affect the saving decision as well. But when those factors got changes, it means that all the other factors remain the same, which means that given the same prices, which is the real interest rate, the saving need to be increased, for example, or the saving need to be decreased. Because of that, any changes to current income, future income, initial wealth, government expenditure, and taxes will shift the saving curve. But then if the saving need to change in response to the changes in the R, then it will be associated with changes in the savings that is moving along the curve. Same thing happened to the investment curve. We know that if the interest rate got changed, then if the interest rate is higher, then we are going to choose to invest less. If the interest rate is lower, we are going to choose to invest more. Because of that, when the investment decisions are responding to the changes in the R, which is the real interest rate, then it will again, the point will move along the investment curve. But then if something happens and that affects the marginal product of the capital, then it will associate with shifting of the investment curve. That is because when the marginal product of the capital got changed due to changes in the A, that is the productivity, or changes in the labor input, it implies that, because we didn't say it, the real interest rate remained the same. When the real interest rate remains the same, but the investment need to be either higher or lower, then it implies that the investment curve need to shift. So you need to be aware that under what circumstances the curve will shift, and under what circumstances it just associates with moving along the curve. So in here, we complete the discussion related to the goods market equilibrium. And now we want to move on to talk about the labor market equilibrium.